Welcome, Deep Divers, to Deep Dive English. I'm really glad you're joining us today right here on our YouTube channel. Our mission, as always, is to take fascinating, sometimes pretty complex information and really distill it down into valuable, digestible insights for you. And today we are doing a deep dive into a book that honestly has shifted how a lot of people think about money, life, even themselves. It's Morgan Housel's The Psychology of Money, Timeless Lessons on Wealth, Greed, and Happiness. We're not just reviewing it, we're aiming to unlock a deeper understanding of how your own mind works with money.
That's a perfect setup, because the core idea Housel presents so well is, well, it's kind of surprising, isn't it? Doing well with money, he argues, has surprisingly little connection to how smart you are. Your IQ, your education, your math skills, they aren't the main drivers.
Right, so what is the main driver then?
It's your behavior, plain and simple. And behavior, well, that's the tricky part. It's incredibly hard to teach, hard to change, even if you're brilliant.
It's a bit humbling, that our smarts can get tripped up by our own habits. But you mentioned the book is full of surprising facts, engaging stories. That's what really makes these ideas stick, I think.
Absolutely. It's a journey through financial wisdom that feels much more like exploring human nature, our quirks, our biases, our history, than staring at spreadsheets.
Yeah, less about the numbers, more about us. So buckle up, everyone, because we're about to explore that fascinating intersection where our minds meet our money. All right, let's jump into part one. Housel really sets the stage here, unpacking the surprising role of behavior and perspective. And the very first concept, which I find so enlightening, is this idea he calls no one's crazy. It digs into why our unique experiences lead to such different financial views.
It's foundational, really, because Housel's point is that our personal histories with money are just incredibly diverse. Think about it. Your generation, your parents' finances and their values, the economy you grew up in, the job market when you started out.
And just sheer luck, right?
And a huge dose of luck, absolutely. All these factors mold us, leading to financial behaviors that might look wildly different from the outside, but internally, they feel perfectly logical to us.
So it seems totally irrational to me, might make perfect sense to you, just because our paths have been different.
Exactly. And he uses some really stark examples to illustrate this, like the tech executive he described.
Oh yeah, the brilliant guy. Patented something key for Wi-Fi routers super young, started and sold companies. Successful on paper.
Wildly successful by conventional metrics.
Right.
But Housel paints a picture of his relationship with money as a mix of insecurity and childish stupidity.
That's quite a phrase.
It is. He'd apparently carry huge wads of $100 bills, brag constantly, especially when drinking. There's this one story, just crazy. He gave a valet thousands of dollars to buy gold coins.
Gold coins, why?
Just so he and his friends could skip them like rocks into the ocean, pure flaunting, a desperate need for people to see how rich he was.
Wow, okay, I think I know where this is going.
Yep.
Housel found out later the guy went completely broke, lost it all.
Unbelievable. And then you contrast that with Ronald Read.
Right, Ronald Read. The description alone is amazing. American philanthropist, investor, janitor, and gas station attendant.
Quite the resume.
Born in rural Vermont, first in his family to finish high school, lived an incredibly simple life, fixed cars, swept floors at JCPenney, bought a modest house for $12,000 back when he was 38, lived there his whole life. Very unassuming.
But the story doesn't end there, does it?
Not at all. When Ronald Read died in 2014, aged 92, he became an international news story. Why? Because out of the nearly 3 million Americans who died that year, fewer than 4,000 had a net worth over $8 million.
And Ronald Read was one of them, the janitor?
He was one of them, left a couple million to his stepkids and over $6 million to his local hospital and library.
How? No lottery, no big inheritance?
Nope. Just decades of patient, consistent saving and investing his modest earnings into blue-chip stocks. He just let compounding work its magic over a very, very long time. So you have this tech genius burning through a fortune, and a janitor quietly building an $8 million one. It really makes you think.
It forces you to question what skill really means in finance. Housel points out this kind of extreme contrast is almost unique to money. You wouldn't expect a janitor to perform better heart surgery than a top surgeon, right?
Of course not.
But in investing, Ronald Read massively outperformed the tech executive and maybe even highly educated finance professionals. It drives home the point. It's not primarily about intelligence. It's overwhelmingly about behavior.
And that behavior, as you said, is shaped by our experiences.
Deeply rooted in lived experience. Housel quotes the historian Frederick Lewis Allen, who said the Great Depression marked millions of Americans inwardly for the rest of their lives.
Mm.
But even that experience wasn't monolithic. Think about someone like John F. Kennedy.
From a very wealthy family.
Exactly. He admitted he had no firsthand knowledge of the Depression. He only really grasped its impact by reading about it later at Harvard. It shows how personal experience shapes our understanding far more powerfully than just learning facts.
That's a really strong point. Has this idea that our personal history shapes our financial choices actually been studied, like
Yeah.
academically?
Oh, absolutely. There's solid research on this. Economists Ulrich Malmendier and Stefan Nagel did a big study looking at like 50 years of data on American financial decisions.
And what did they find?
They found that people's investment choices throughout their lives are heavily anchored, that's the term they used, anchored to the economic experiences they had in their own generation.
Especially early on.
Especially experiences early in their adult life. So if you came of age during a period of high inflation, you're likely to invest less in bonds later on, even if inflation is low then.
And if the stock market was booming when you were young?
You're probably going to be more comfortable putting more money into stocks throughout your life. It's basically the dumb luck, as Housel puts it, of when and where you were born shaping your financial instincts.
That explains so much. We all carry these invisible scripts based on our past. It reminds me of Housel's point about the lottery ticket paradox.
Yes, that's a fascinating one.
You see low-income households spending, what was it, like $400 a year on average on lottery tickets?
That's the figure, yeah. Often the same group who report they couldn't cover a $400 emergency expense.
Which, on the surface, sounds completely irrational, right? Why spend money you don't have on something with astronomically low odds? How does that fit with no one's crazy?
It's a really important question because rationally, statistically, it's a bad financial move, no doubt. But Housel pushes us to think about the reasonable subconscious motivation, not just the cold rationality.
Okay, so what's the reasonable angle?
For someone living paycheck to paycheck, maybe seeing little chance for a raise or significant savings, that lottery ticket isn't just a piece of paper. It represents a tangible dream. It's buying hope. The hope of a vacation, better health care, getting out of a rough neighborhood, things many others might take for granted.
So it's like paying a small amount for the feeling of possibility, even if the odds are terrible.
Exactly. It's the only way they might feel they can access that kind of life-changing possibility. So while it might not be rational finance, it's a reasonable emotional purchase from their specific perspective and experience. It acknowledges the human need for hope.
That's a really empathetic way to look at it. And it also connects to another point he makes, just how new all this modern finance stuff is.
Totally. Money itself is ancient, obviously. But think about widespread retirement planning. 401k, Roth IRAs.
Relatively recent inventions, really.
Very recent. The 401k only came about in 1978. The Roth IRA wasn't until 1998. They're practically teenagers in the grand scheme of financial history.
And before that, people just worked until they couldn't anymore.
Pretty much, for most of history. The idea that everyone deserves a comfortable retirement funded by their own savings and investments, that really only took hold widely in the last few decades, maybe since the 1980s.
Same with things like mortgages and credit cards being so common.
Similar story. Widespread consumer debt only exploded after World War II. So we're dealing with systems that are maybe 20 to 50 years old in terms of mass participation.
Which means?
It means, as Adel puts it, we're not crazy, we're all just newbies. We haven't had generations to collectively learn the ropes, develop societal wisdom around these tools. We're all kind of figuring it out as we go.
Winging it.
We're totally winging it. And that lack of deep, accumulated experience explains a lot of the behaviors that might look like poor decisions from a purely rational standpoint.
Fascinating. So our unique histories, our generational context, the sheer newness of it all, it creates this environment where judging others' financial choices is often missing the point. But Housel doesn't stop there. Beyond our internal perspectives, he talks about these huge external forces, luck and risk.
Yes, the next big theme, luck and risk. He stresses they're like siblings, inseparable, two sides of the exact same coin. Meaning that every outcome in life, every outcome is guided by forces that go way beyond just your individual effort. Intelligence, hard work, they matter, but they're not the whole story.
It reminds me of that quote you mentioned, nothing is as good or as bad as it seems.
Exactly. That's Scott Galloway's line, and it captures it perfectly. Luck and risk are hard to see, hard to measure, and honestly, pretty hard for us to accept, especially when it comes to our own successes or failures.
We like to take credit for the good stuff and blame external factors for the bad.
We absolutely do,
Yeah.
which leads to misinterpreting why things happen the way they do.
And he uses a really powerful story to illustrate this, doesn't he?
Yeah.
Involving someone very famous.
Yeah.
Obviously, incredibly smart, incredibly hardworking. No one denies that.
Definitely not. But Housel highlights the element of luck. Gates had what he calls 1 in a million luck starting out. In 1968, when Gates was just 13, he attended Lakeside School in Seattle. Lakeside was one of the only high schools in the world at that time that had a computer.
That's amazing for 1968.
It's incredible. The school's Mothers Club had raised money from rummage sales to lease this advanced teletype Model 30 computer. Most universities didn't have access like that then. Gates and his classmate Paul Allen got basically unlimited time on it. It let them become programming experts years before almost anyone else their age.
So that access was the lucky break.
Gates himself said if there had been no Lakeside, there would have been no Microsoft. A massive head start.
But then there's the flip side of that luck coin, the risk part of the equation. His friend, Kent Evans.
Kent Evans. Gates describes him as his best friend back then, equally brilliant, maybe even the best student in their class, shared the same intense ambition and fascination with computers.
They planned to build things together.
Absolutely. They dreamed about running companies together. Gates felt Evans would likely have been a founding partner of Microsoft, but Kent Evans died in a mountaineering accident before he even graduated high school, a random, tragic event. Housel frames it as 1 in a million risk.
Wow. So Gates gets the 1 in a million opportunity, and Evans encounters the 1 in a million tragedy.
Exactly. Same force chance, luck, risk, same magnitude, just working in opposite directions. It starkly illustrates how much is outside our individual control.
It really challenges the narrative that success is purely about individual merit or failure is purely about mistakes.
It does. And that difficulty in attributing outcomes correctly is a real problem. Robert Shiller, the Nobel economist, apparently wished he knew the exact role of luck in successful outcomes, but it's almost impossible to measure.
And socially awkward, too, right? Pointing out someone else's luck can sound like jealousy. Admitting your own success involved luck can feel, I don't know, diminishing.
It can. And we tend to do the opposite with failure. Someone else fails. Oh, they made bad choices, we fail. That was just bad luck, the dark side of risk striking us down.
You see the skew in how success is reported, too, like those Forbes lists celebrating the ultra-rich.
Exactly. They highlight investors who got incredibly wealthy, maybe through reckless bets that just happened to pay off due to luck. But you rarely see stories celebrating the prudent investor who made all the right decisions but got wiped out by unforeseen bad luck.
Which gives you a distorted picture of what actually works.
A very distorted picture. It leads to what Housel called dangerous analysis.
Like praising someone like Cornelius Vanderbilt.
Yeah, the railroad tycoon. Hugely successful, but also famously broke laws and basically said, what do I care about the law? Ain't I got the power?
His willingness to flaunt rules was part of his success, but Housel warns against calling that sage wisdom.
Yeah.
You can't just advocate crime because it worked for one outlier.
The line between bold and reckless is thin.
Incredibly thin, and often you only know which side someone was on with the benefit of hindsight. Was it bold or reckless? Often depends entirely on the outcome, which involves luck. Like Mark Zuckerberg, turning down Yahoo's billion-dollar offer for Facebook back in 2006. Genius now, but could have looked foolish.
Precisely. Or Yahoo itself getting criticized later for turning down Microsoft's offer. It's so ambiguous. Was it genius foresight or a lucky gamble that paid off? Was it a foolish mistake or prudent foresight that didn't? Hindsight bias makes it seem obvious, but it rarely is at the time.
So, the big takeaway from luck and risk. Be careful who you admire and who you dismiss. Look for broad patterns, not just extreme outliers who might have been lucky.
And realize that success can be a lousy teacher, as Housel says. It can make smart people think they're invincible. Conversely, failure isn't always deserved. The most important thing is arranging your finances so that one bad investment or one piece of bad luck doesn't wipe you out completely. Survival is key.
That focus on survival, on not getting wiped out, leads us perfectly into part 2, where Housel tackles some core behavioral traps. The first one is huge. Never enough. The illusion of more.
Yes. This is such a powerful chapter. The core idea is that the relentless pursuit of more money, more status, more stuff often leads people, even incredibly wealthy people, down a path to regret and sometimes outright ruin.
Because the goalpost keeps moving.
Exactly. A critical, maybe the most critical financial skill is learning how to get the goalpost of your expectations to just stop moving, to recognize when you have enough.
He uses that great anecdote involving Joseph Heller, the author of Catch-22.
Right, the story told by John Bogle, Vanguard's founder. They were at a billionaire's party, and Kurt Vonnegut pointed out that their host, a hedge fund manager, probably made more money in a single day than Heller had earned from his masterpiece novel Catch-22 over its entire lifetime.
And Heller's response was just perfect.
He was profound. Heller simply said, "Yes, but I have something he will never have."
Enough.
Enough. Such a simple word, but it holds so much wisdom about contentment and the dangers of comparison.
And Housel provides some pretty stark examples of people who clearly lost sight of enough, even when they had staggering amounts of wealth, like Rajat Gupta.
Yeah, Rajat Gupta. A truly incredible story in some ways. Born in Kolkata, orphaned as a teen, rose to become CEO of McKinsey, sat on the board of Goldman Sachs, achieved unimaginable wealth and prestige.
Had everything by any normal measure.
Everything. Yet he threw it all away. He got caught up in insider trading.
What exactly did he do?
He was on the Goldman Sachs board call where they discussed Warren Buffett making a crucial $5 billion investment during the 2008 crisis. 16 seconds after that call ended, Gupta phoned a hedge fund manager he was involved with.
Oh, no.
That manager immediately bought a ton of Goldman stock, making about $1 million instantly when the news broke. Gupta's tips allegedly led to $17 million in illegal profits overall.
And the consequences.
Prison, reputation destroyed, career over. All because, despite having hundreds of millions, he was chasing what the SEC called lucrative side hustles. He didn't know when enough was enough.
It's baffling. Why risk everything when you already have so much?
That's the central question Housel poses. Why did Gupta, or Bernie Madoff for that matter, who ran a huge, legitimate, and highly successful market-making business alongside his Ponzi scheme, why did they risk it all for even more?
The answer seems to be
They had no sense of enough. It highlights this really dangerous dynamic. When the taste of having more money, more power, more prestige increases your ambition faster than it increases your satisfaction.
you feel like you're falling behind, even as you gain more.
Exactly. So you feel the need to take bigger and bigger risks just to keep up with your own escalating desires. It's a dangerous spiral.
And social comparison fuels this, right?
Massively. Housel says modern capitalism is great at generating wealth, but it's equally great at generating envy. The ceiling of social comparison is so high that virtually no one will ever hit it.
Yeah.
There's always someone richer, more successful. A baseball player compares himself to a bigger star, who compares himself to a hedge fund manager, who compares himself to Bezos.
It's a game you literally cannot win.
Cannot win. Which is why that casino analogy Housel mentions is so good. Derek Sivers had a friend compare wealth building to playing in Vegas.
And the only way to win is
To exit as soon as you enter, meaning you have to know your enough point and be willing to walk away from the table, stop chasing more before you risk losing what you already have.
It's important to clarify, though. Enough doesn't mean being timid or leaving opportunity on the table necessarily.
No, not at all. It's not about being overly conservative. It's about realizing that the insatiable appetite for more eventually pushes you past the point of optimization and into the zone of regret. Housel uses the analogy eating. We learn how much food we can handle by eating until we get sick. But we often don't apply that same logic to ambition and money. We don't recognize the point where more starts to hurt us.
That's a great way to think about it, finding that full point financially and ambition-wise. Okay, so if chasing more is a trap, what about the actual growth of money? This leads us to confounding compounding.
Yes, the power of compounding. This is another concept where our intuition often fails us. The core idea is simple. If something compounds, meaning a little bit of growth, creates the base for future growth, then even a tiny starting point can lead to results that seem completely illogical, absolutely extraordinary.
And we tend to underestimate this power.
Massively underestimate it. Because
Yeah.
our brains naturally think in linear terms, add a little, not exponential terms, multiply a little, multiply a little. Housel uses a really cool, unexpected example to illustrate this. Ice ages.
Ice age, okay, intriguing. How does an ice age demonstrate compounding?
Well, back in the early 1900s, scientists were figuring out what caused them. A Serbian scientist, Milankovic, linked them to subtle shifts in Earth's orbit affecting solar radiation. But a meteorologist named Kupin added a key insight. It wasn't necessarily brutally cold winters that caused ice ages, it was moderately cool summers.
Cool summers, not cold winters. How does that work?
If a summer is just slightly too cool to melt all of the previous winter's snow, even a thin layer remains. That leftover snow makes it easier for more snow to accumulate the next winter. Plus, the leftover ice reflects more sunlight, which cools the area slightly, making it even harder for snow to melt the following summer.
Ah, I see. It's a feedback loop. A small initial change triggers a growing effect.
Exactly. A tiny bit of unmelted snow compounds year after year. Over centuries, that small initial change, a slightly cooler summer, can result in a massive continental ice sheet, miles thick. A small change, tremendous results.
That's a fantastic analogy for financial compounding. A little bit of growth reinvested leads to more growth, which leads to even more.
Precisely. And Housel immediately connects this to the most famous example in finance, Warren Buffett.
Everyone focuses on his stock-picking genius, right?
They do, and he's brilliant at it. But Housel argues that focusing only on his skill misses the bigger, simpler factor.
Yeah.
Get this. Of Buffett's roughly $84.5 billion net worth, Housel cites $84.2 billion. Almost all of it was accumulated after his 50th birthday.
Wow. So the vast majority came later in life.
And even more staggeringly, about $81.5 billion came after he qualified for Social Security in his mid-60s. His real secret isn't just being a great investor, it's being a phenomenal investor for 3/4 of a century. The sheer duration is key.
He does that thought experiment, too.
Yeah.
What if Buffett had started later or retired earlier?
Right. If Buffett started investing in his 30s, like most people, and retired in his 60s, even with his amazing 22% annual returns, his net worth would be maybe $11–12 million, not $84 billion. Impressive, sure, but hardly legendary. Most people wouldn't have heard of him.
It really underscores the time factor over just the rate of return factor.
It does, and he contrasts Buffett with Jim Simons of Renaissance Technologies.
The quantitative hedge fund guy. Insane returns, right?
Absolutely insane. Simons has compounded money at something like 66% per year since 1988. That's 3 times Buffett's annual rate.
So Simons must be way richer than Buffett then.
Nope. Simon's net worth is about $21 billion, which is incredible, obviously, but it's 75% less than Buffett's.
How can that be, with triple the returns?
Time. Simons didn't really hit his investing stride until he was 50. He had less than half as much time for that incredible compounding rate to work its magic compared to Buffett. Housel runs the numbers. If Simons had achieved 66% returns for the 70 years Buffett was investing, his net worth would be some absurd, nonsensical number involving quintillions of dollars. It just shows how duration magnifies everything.
Our brains just aren't built to grasp that kind of exponential growth easily. We think linearly.
Totally. He uses hard drive storage as another example. From a few megabytes in the 50s to maybe 500 megs in the 90s to terabytes today, it's exponential. Even Bill Gates initially missed it, questioning why Google would offer a whole gigabyte of storage with Gmail back in 2004. He was still anchored in the old linear thinking about storage costs.
So the big lesson from compounding isn't necessarily to chase the absolute highest returns possible.
No, it's about finding pretty good returns that you can actually stick with consistently for the longest possible period of time. Patience and duration are the magic ingredients. Housel jokes the best investing book would just be called Shut Up and Wait, with a single chart of long-term economic growth. That's when compounding really goes wild.
And sticking with it, enduring through the ups and downs, is where survival comes in again, which leads to the next section. Getting wealthy versus staying wealthy.
The crucial distinction. Because the mindset and skills needed for each are often opposites.
How so?
Getting wealthy usually requires taking risks, being optimistic, putting yourself out there, maybe being aggressive. But keeping wealth, that requires humility. It requires acknowledging luck played a role, so past success isn't guaranteed. It requires frugality. It requires a healthy dose of fear or paranoia about losing what you've built.
So optimism gets you there, pessimism keeps you there? Sort of.
In a way, yes. Housel says if he had to pick one word for money success, it's survival. Staying in the game is paramount.
He uses that dramatic comparison from the 1929 crash again, right? Jesse Livermore and Abraham Jermansky.
He does. Livermore, the trading legend, made the equivalent of $3 billion in one day in 1929 by correctly shorting the market crash. Genius move.
Amazing timing.
Meanwhile, Abraham Jermansky, a wealthy real estate developer, had bet heavily on the rising market. The crash wiped him out completely. He vanished in despair.
So Livermore was great at getting wealthy. Jermansky wasn't in that moment. But there is a twist.
The twist is that Livermore, despite that incredible $3 billion win, also eventually lost everything. He kept making huge, leveraged bets, got caught on the wrong side later, and eventually took his own life. Both men were brilliant at getting wealthy at different times. Both were equally bad at staying wealthy.
It's a chilling lesson about the importance of longevity, of just surviving.
Absolutely. He quotes Michael Moritz from Sequoia Capital, the legendary venture capital firm. Moritz said their 4 decades of success weren't just from picking winners, but from being always afraid of going out of business. That paranoia kept them disciplined.
Only the paranoid survive, as Andy Grove said.
Exactly. Compounding needs time. Survival gives you time. Housel points out that Warren Buffett's success isn't just his brilliant investments, but also what he didn't do.
His undos.
Yeah. He didn't get crippled by debt. He didn't panic and sell during downturns. He didn't ruin his reputation. He didn't chase fads. He didn't burn himself out. He just survived. He stayed in the game decade after decade.
He tells that story about Rick Guerin, too, the third member of the early Buffett-Munger partnership.
Right. Buffett said Guerin was just as smart as him and Munger, but he was in a hurry. Guerin used a lot of leverage. When the market had a sharp downturn in the 70s, he got margin calls and was forced to sell his Berkshire Hathaway stock back to Buffett at rock bottom prices.
Ouch. Ruined by being in a hurry and using debt.
It wiped him out of that opportunity. It echoes Nassim Taleb's point. Having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs.
So the practical application here is to focus on being financially unbreakable.
That's the goal. Prioritize that over simply maximizing returns in the short term. Think about holding cash, for example. In a roaring bull market, holding cash feels inefficient, like you're missing out on gains.
Yeah, it feels like you're losing.
But if that cash buffer prevents you from being forced to sell your stocks at the bottom of a crash when you lose your job, its true return is immense. Avoiding that one catastrophic mistake can be worth more than years of market-beating gains.
Because staying invested is what allows compounding to work long-term.
Precisely. Merely good returns sustained uninterrupted for the longest period of time, Housel writes, will always win. Endurance trumps short-term brilliance if that brilliance leads to blow-ups.
This focus on endurance on the human side really flows into part 3, which offers some very practical wisdom. I love the first point. Freedom, wealth you don't see, and saving money. Especially the idea of freedom being the real goal.
Yes. This reframes the whole purpose of money for many people. Housel argues that the ultimate goal, the highest form of wealth, isn't fancy stuff. It's control over your time. The ability to say, I can do what I want, when I want, with who I want, for as long as I want. That, he says, is priceless. It's the highest dividend money pays.
And there's psychological backing for this.
Oh, yeah. He cites psychologist Angus Campbell's work, which found that having a strong sense of control over your own life is a better predictor of happiness and well-being than almost any objective measure, like income or job title.
Control matters more than the actual conditions.
It seems so. Feeling like you're the one steering your ship is fundamental to happiness. Housel shares his own experience with this.
The investment banking internship.
Right. He thought he wanted the money and prestige. He actually enjoyed the intellectual challenge of the work itself, but he hated the internship. Why?
The hours, the lack of control.
Total lack of control over his time, being told when to show up, when to leave, what to do 24/7. He realized doing something you love on a schedule you can't control can feel the same as doing something you hate.
That's powerful. It's that psychological reactance kicking in.
Exactly. We resist when our autonomy feels threatened. He also tells Derek Siever's story about becoming free.
Oh, the CD Baby founder.
Yeah. Sievers felt truly free. Not when he sold his company for millions, but years earlier when he was 22. He'd saved up just $12,000.
$12,000 made him feel free.
Because it was enough for him to quit his day job and pursue being a full-time musician, which was his dream then. That modest amount of savings bought him control over his time long before the big exit. Freedom came from savings, not immense riches.
Which ties directly into that brilliant man-in-the-car paradox.
Ah, yes. This one really hits home for a lot of people.
The idea that when we see someone in a really fancy car, like a Ferrari.
We don't usually think, wow, the person driving that car is cool.
Right. No. We think, wow, if I had that car, people would think I'm cool.
Exactly. It's an internal projection. We use the other person's display of wealth as a benchmark for our own desire for admiration and respect. We completely bypass admiring the actual owner.
So the expensive car doesn't actually buy the admiration the driver might be seeking.
Rarely does, Housel argues. especially from the people whose respect you truly value. He says the message to his son is blunt. If you want respect, focus on kindness and humility, not flashy possessions.
Which leads right into the concept. Wealth is what you don't see.
This is such a core definition Housel offers. Wealth isn't the fancy car, the big house, the designer clothes. That's just spent money. Wealth, he says, is financial assets that haven't yet been converted into the stuff you see. It's the money not spent, the car not bought, the upgrade declined.
It's the money still working for you, generating potential future options and freedom.
Precisely. It's hidden. He tells the story of Roger, the valet who drove a Porsche. Everyone assumed Roger was rich.
But he wasn't.
Nope. The car was eventually repossessed because he couldn't make the payments. He looked rich, but he wasn't wealthy. It was an illusion. It highlights the difference between rich, high current income, often spent visibly, and wealthy, assets accumulated often invisibly through saving.
Like Rihanna apparently getting frustrated with her financial advisor who had to explain that spending money means you end up with the things, not the money.
Right. It seems obvious, but the allure of visible consumption is strong. Spending money is literally the opposite of being wealthy. The problem is, it's easy to find rich role models, people spending lavishly. It's much harder to find wealthy role models, the quiet accumulators like Ronald Read, because their wealth is invisible.
And this brings us squarely to the power of saving money.
The bedrock. Housel argues forcefully that building wealth has surprisingly little to do with your income level or even your investment returns. It has lots to do with your savings rate.
More controllable, too.
Far more controllable. He uses the analogy of the 1970s oil crisis. The world didn't just solve it by finding more oil. A huge part of the solution was becoming radically more energy efficient.
Cars, factories, homes all use way less energy now per dollar GDP.
Exactly. We increased our energy wealth partly by needing less energy. Similarly, he argues, your personal financial strength grows significantly through conservation and efficiency, basically. Frugality and a high savings rate. That's the part you have the most direct control over.
He has that great line about ego and income, too.
Past a certain level of income, what you need is just what sits below your ego. Meaning a powerful way to boost your savings isn't necessarily earning more, but desiring less, caring less about what others think.
Raise your humility, he suggests.
Which in turn lowers your spending and allows your savings rate the gap between your ego and your income to grow. And you don't even hit a specific goal for those savings. Saving for saving's sake is powerful.
Why is that?
Because savings represent options, flexibility, control over your time. It's a hedge against the inevitable curveballs life throws at you, often at the worst possible moment. Savings buy you breathing room and resilience.
That resilience, that ability to handle life's messiness, feels connected to the next idea, aiming to be reasonable, rational.
Yes, this is such an important practical insight. Housel argues we shouldn't strive to be coldly rational, like a computer optimizing numbers when making financial decisions.
Because we're humans, not spreadsheets.
Exactly. We have emotions, biases, fears, aspirations. Trying to be purely rational often fails because it's not sustainable. It's better, he suggests, to aim to be pretty reasonable.
What's the difference in practice?
Reasonable is more realistic. It acknowledges the human element. It leads to decisions you can actually stick with for the long haul, which is crucial for investing success. Sticking with a pretty good plan is way better than abandoning a perfectly rational plan because it feels emotionally unbearable.
He uses that wild historical example of curing syphilis with malaria.
Malaria therapy. Yeah, it's a bizarre story. Dr. Wagner Jahreg won a Nobel Prize for it. He noticed syphilis patients sometimes improved if they survived a high fever from another illness.
So he deliberately infected them with malaria. That sounds risky.
Incredibly risky, but it worked significantly better than anything else at the time. The high fevers killed the syphilis bacteria. Rationally, inducing a fever was beneficial. Yet, what do we all do when we get a fever?
Reach for the Tylenol, try to bring it down immediately.
Right, because fevers hurt, and people don't want to hurt. Even though the fever might be medically helpful, rational, suppressing it feels better, reasonable, doctors have to balance optimal treatment with patient comfort and tolerance.
So applying that to finance, we might make choices that aren't mathematically optimal, but help us sleep at night.
Precisely. He cites Harry Markowitz, the guy who won a Nobel for modern portfolio theory, the mathematical underpinning of diversification. Markowitz confessed he didn't use his own optimal formulas for his own retirement savings.
What did he do instead?
He just split his money 50-50 between stocks and bonds. Why? To minimize my future regret. He prioritized his emotional comfort over pure mathematical optimization.
Because real-life decisions aren't made in a vacuum.
No, they're made in a conference room surrounded by coworkers you want to think highly of you, with a spouse you don't want to let down, Housel writes. Context matters. Emotions matter.
It makes those purely academic finance recommendations seem a bit absurd sometimes, like the study advocating massive leverage for young investors.
Oh, yeah. The Yale study suggesting young people should use 2.1 leverage, even if it means risking a 100% wipeout early on, because they have time to recover. Housel calls that technically true but contextually nonsense. No normal human being could emotionally withstand losing everything like that and just calmly pick themselves back up and start over. It ignores the psychological reality.
So being reasonable might mean accepting slightly lower potential returns for a strategy you can actually live with.
Exactly. It might even mean things that seem counterintuitive, like Housel suggesting you should love your investments.
Love them. Like emotionally attached. Isn't that usually seen as bad?
Typically, yes. But his point is that a little emotional attachment might actually be an edge. If you genuinely like the companies you own or believe in the long-term index fund strategy, you might be more likely to stick with it through the inevitable downturns, which allows compounding to work. It's reasonable, if not purely rational.
And sticking with it requires surviving those downturns, which brings us back to room for error.
The margin of safety. This is critical for navigating a world that's inherently unpredictable. It's not just about being conservative, it's about increasing your odds of staying in the game long enough for the good stuff to happen.
And you need it because the biggest risks are often the ones you don't see coming,
Yeah.
like the German tanks and the mice.
Such a great story. Stalingrad, WWII. Some of the most advanced, heavily armored tanks in the world were being rendered useless. Not by enemy shells, but by field mice getting inside and chewing through the electrical wire insulation.
You couldn't make it up. Mice taking out tanks.
It shows you can plan for every known risk: enemy attacks, mechanical failure. But the things that are too crazy to cross your mind, the completely unforeseen stuff, can sometimes do the most damage. Room for error protects you from the unknown unknowns.
So how do you build room for error financially? Avoid single points of failure.
That's a big part of it. Just like airplanes have backup systems, your finances need buffers. The most obvious single point of failure is relying solely on your next paycheck with zero savings. One job loss, and you're sunk.
Even financial giants practice this. Bill Gates keeping cash for Microsoft's payroll.
Yeah, when Microsoft was young and vulnerable, Gates insisted they always keep enough cash in the bank to cover a full year's payroll, even with no revenue coming in. An incredibly conservative approach, but it ensured survival. Buffett does the same with Berkshire, pledging to always run Berkshire with more than ample cash, refusing to trade a night's sleep for the chance of extra profits.
So it's about prioritizing survival and peace of mind over squeezing out every last potential percentage point of return.
Exactly. Housel mentions his own practice. When estimating future investment returns for his planning, he assumes they'll be about 1/3 lower than the historical average,
Why lower?
as a margin of safety. If returns end up being average or better, great. If they're lower, his plan still works because he built in that buffer by saving more. It lets him sleep at night. It aligns with Charlie Munger's advice. The best way to achieve felicity is to aim low.
It avoids that Russian roulette should statistically work syndrome, right?
Precisely. Playing Russian roulette is statistically likely to work 5 out of 6 times. But the downside of that one failure is absolute and unacceptable. You must take some risks to get ahead financially. But, Housel stresses, no risk that can wipe you out is ever worth taking. Leverage or debt is often the culprit here, turning normal market volatility into a potentially ruinous event.
Like homeowners in 2009 who lost everything because they were over-leveraged.
Exactly. Debt removes your room for error. It forces you to sell at the worst possible time. Having that buffer, that margin of safety, is what allows you to ride out the storms and get back in the game. He talks about the barbelled approach, too, being conservative with most of your money, but taking calculated risks with a small portion.
And it's not just financial room for error, but psychological too.
Yes. Can you mentally handle seeing your portfolio drop 30% without panicking? Spreadsheets don't model that feeling when you're tucking your kids in at night wondering if the investment decisions you've made were a mistake. You need emotional room for error, too.
Which connects to the idea that returns aren't free. There's always a price. Nothing's free.
A fundamental truth. Everything worthwhile has a cost, a price of admission. And in investing, the price of potentially earning good long-term returns is unavoidable. It's paid in volatility, fear, doubt, uncertainty, and regret.
Things we naturally want to avoid.
Of course, we instinctively try to get the reward or returns without paying the price, volatility, like trying to get a free lunch. But Housel argues this attempt to get something for nothing rarely ends well.
He uses the historical market returns as an example.
Yeah, the Dow Jones averaged about 11% per year over many decades. Sounds great, but that return came with a dreadfully high price. The market constantly taunts you. Even hugely successful stocks like Netflix or Monster Beverage spent 94 and 95% of the time trading below their previous all-time high. It's a constant roller coaster of drawdowns and doubt. That's the price.
He uses that car analogy again, buying versus stealing.
Right. You can pay $30,000 for a new car. You can buy a cheaper used one. Or you can try to steal it. He says many investors, often well-meaning, try to steal market returns by using strategies designed to avoid the price of volatility, things like market timing or complex tactical funds.
But backfires.
Often, they end up paying double, either through fees, bad timing, or just missing out on the gains they were trying to capture smoothly. He points to GE under Jack Welch as an example of trying to create an illusion of smooth, predictable earnings growth.
Manipulating earnings per share.
Essentially, yes. Shielding shareholders from the normal volatility of the price. It looked great for a while, those steady penny gains, but eventually the bill came due, leading to massive dime losses later when reality caught up. You can't avoid the price forever.
So the key is accepting that volatility is part of the deal.
Yes, and crucially, reframing how you view it. This is maybe the most important mental shift Housel suggests. View market volatility not as a fine, a penalty for doing something wrong, something to be avoided at all costs.
But as a fee.
Exactly, like a fee for a service or the price of admission to a theme park. It's the cost you willingly pay to access the potential for long-term growth. Fines make you want to stop doing whatever caused them. Fees are just the price of entry for something you desire.
If you see volatility as a fee, you're more likely to stick around and pay it, allowing your investments time to work.
That's the idea. It's essential for staying invested long enough for those potential gains to actually materialize. You have to endure the price.
And understanding who else is floating fees and why leads to the final point in this section. You and me playing different financial games.
This explains so much confusion and, frankly, bubbles in the market. Housel's point is that financial markets often seem irrational because investors are innocently taking cues from other investors who are playing a different game than they are.
Meaning we don't all have the same goals or time horizons.
Not even close. The idea that any asset, like Google stock, has one single rational price is flawed. Why? Because the person planning to hold it for 30 years is playing a totally different game than the day trader planning to hold it for 30 minutes.
They value different things, look at different signals.
Completely different. The day trader cares about momentum, short-term sentiment, maybe technical chart patterns. The long-term investor cares about underlying business value, competitive advantages, long-term growth prospects.
So bubbles happen when one group's game starts dominating.
That's a key insight. Bubbles aren't just about irrational optimism. They often occur when the momentum of short-term price increases attracts so much money that the makeup of investors shifts heavily towards short-term traders. Think about the dot-com bubble. Cisco trading at insane valuations that implied impossible future growth.
That price made 0 cents for a long-term investor focused on fundamentals.
0 cents. But for a trader just trying to ride the upward momentum for a few days or weeks, buying at that high price might have seemed reasonable for their game. They planned to sell it quickly to someone else playing the same short-term game.
And the housing bubble. Flippers focused on month-to-month price jumps, not long-term rental income or value.
Exactly. They were playing a short-term trading game with houses. The danger comes when people playing a different game, like long-term investors or regular homebuyers, get caught up in that momentum and start using the short-term traders' prices as their signals.
Like the long-term investor buying Cisco at $60 in 1999 because everyone else was doing it, without realizing they were mimicking players in a totally different league.
That's how disaster happens. You're taking cues from people whose goals and time horizons are completely misaligned with yours. And this isn't just about investing. It applies to spending, too. Trying to keep up with the Joneses' spending without realizing Mr. Jones might be playing a different game, higher income, different priorities, maybe more debt tolerance, can lead to trouble.
So the crucial takeaway is, Define your game.
Absolutely essential. You need to be crystal clear about your financial goals, your time horizon, your risk tolerance. What game are you playing? Housel shares his own mission statement as an example. I am a passive investor, optimistic in the world's ability to generate real economic growth, and I'm confident that over the next 30 years, that growth will accrue to my investments.
Having that clarity helps filter out the noise.
Immensely. Once you know your game, you can ignore the actions and opinions of people playing different games. The day-to-day market chatter, the predictions about next quarter, it becomes irrelevant to your long-term strategy. It stops you from getting pulled off course.
That's a really empowering framework. Okay, moving into the final part 4, where we look at overcoming biases and applying these lessons. First up is a really interesting one, the seduction of pessimism.
Yeah, why does bad news seem to grab our attention so much more than good news? As the historian Deidre McCloskey put it, for reasons I have never understood, people like to hear that the world is going to hell.
Pessimism just seems stickier, maybe? Smarter somehow?
It often does sound smarter, more intellectual. Optimism can easily be dismissed as naive or oblivious to risk, but Housel distinguishes between blind optimism and what he calls sensible optimism. Sensible optimism isn't denying problems, it's having a belief that the odds of a good outcome are in your favor over time, even when there will be setbacks along the way. It's trusting in general human progress and ingenuity.
But pessimism definitely gets more headlines. He mentions that wild prediction for 2008.
Oh, Igor Panarin. Yeah, December 2008, right at the bottom of the financial crisis. The Wall Street Journal runs a front-page story about this Russian professor predicting the U.S. would completely disintegrate into 6 separate regions by 2010.
Front page. Seriously.
Front page. California going to China, Texas to Mexico, Alaska back to Russia. Pure apocalyptic fantasy. But it got serious attention because pessimism feels urgent and credible, especially during crises. Contrast that with an imagined, wildly optimistic forecast for, say, Japan right after WWII, predicting massive economic growth, soaring life expectancy, global leadership. That forecast actually came true, but if someone had made it back then, they would have been laughed out of the room.
So why is pessimism so seductive? What are the psychological drivers?
House outlines a few. First, there's an evolutionary bias. Daniel Kahneman's work shows threats feel more urgent than opportunities. Loss aversion is powerful. Bad news triggers our survival instincts. Second, money is everywhere. Financial downturns affect almost everyone, so they get universal attention, unlike, say, a specific scientific breakthrough.
Makes sense. It's personal.
Third, narratives are easier to build around destruction. A plane crash is a dramatic story. Decades of incremental safety improvements are not. Pessimism makes for better, more immediate stories. Also, pessimists often just extrapolate current negative trends indefinitely, without accounting for how markets and people adapt. Think of all the peak oil predictions that missed the fracking revolution.
And progress is slow. Setbacks are fast.
Exactly. Progress happens incrementally, almost invisibly. Setbacks, market crashes, pandemics happen quickly and dramatically. So bad news feels more real, more impactful in the moment.
It grabs you. And that idea of powerful stories leads to the next chapter, when you'll believe anything.
This is about the immense power of narratives, appealing fictions, and how we make decisions based on incomplete views of the world. Housel argues stories are often more potent than statistics in shaping our beliefs.
He uses that alien thought experiment.
Right. Imagine an alien visiting Times Square in 2007, then again in 2009. Visually, not much difference. Still bright lights, crowds, maybe slightly better smartphones in '09. The alien would completely miss the massive economic earthquake that happened between those visits, because the real story wasn't in the tangible buildings, it was in the invisible stuff. Confidence, fear, trust the human stories that drive economies.
And we cling to stories, especially when we want them to be true.
Desperately. He calls them appealing fictions, like the old woman on Armistice Day in 1918 believing fervently that WWI was the war to end all wars, that there would be no more wars ever again. A beautiful hope born from unimaginable suffering, but ultimately a fiction.
Or that harrowing story of the Yemeni father.
Ali Hajaji. His son was terribly sick, and he had no money for doctors. He resorted to a dangerous folk remedy involving a burning stick, hoping it would cure his son. He later said, reflecting on his desperation, "When you have no money and your son is sick, you'll believe anything."
High stakes and lack of control make us vulnerable to believing almost anything that offers hope.
Exactly, and that same psychology applies to finance. Why do people cling to inaccurate TV pundits shouting stock tips? Why did so many smart people fall for Bernie Madoff's impossible steady returns? Because the desire for a solution, for easy wealth, for a guaranteed positive outcome can be so overwhelming that we become willing to believe stories that have a very low probability of being true. The appeal of the story overrides rational assessment.
And we build these stories even with incomplete information.
Constantly. Housel emphasizes that we all have an incomplete view of the world. We only see a tiny fraction of what's going on. But our brains hate uncertainty, so we automatically form a complete narrative to fill in the gaps.
We create a coherent story even if it's based on limited data.
Yes. Kahneman calls it WYSIOT. What you see is all there is. We focus on what we know, neglect what we don't know, especially the role of luck, and build confident narratives based on that incomplete picture. This leads to overconfidence and the illusion that the world is more predictable than it is.
And the danger is acting on those potentially flawed narratives, like following someone else's financial choices without understanding their full context or game.
Precisely. That's how we get swept up in bubbles or make decisions that are wrong for us, based on an incomplete and possibly fictional story we've told ourselves or bought into from others. The power of narrative is immense for good and ill.
Okay, so bringing all these deep, often counterintuitive ideas together, how do we apply them? The chapter, All Together Now, tries to summarize the actionable lessons.
It does. It's Housel's attempt to synthesize the book's wisdom into practical guideposts for navigating our financial lives more effectively. He starts with humility and forgiveness.
Recognizing that things are never as good or as bad as it looks.
Exactly. Acknowledge the role of luck and risk in your own life and in others. This helps you focus on what you can control and learn from more reliable patterns, not just extreme outcomes.
And connecting back to earlier points, left ego, more wealth.
Right. Suppress the need for immediate gratification, the desire to impress others with spending. Remember, wealth is the stuff you don't see. Saving creates future options.
Sleep well at night is a big one too.
Hugely important. Your financial strategy should be designed primarily to maximize your peace of mind, not necessarily to maximize every last dollar of return. Reasonableness over pure rationality again.
And increase your time horizon.
Because time is the magic ingredient in compounding. A longer time horizon makes big mistakes less damaging and allows small advantages to grow enormously.
He also emphasizes being okay with things going wrong.
Yeah, except that most individual bets or investments probably won't be huge winners. Success often comes from a few tail events, a small number of things that work out spectacularly well. Judge your overall progress, not every single decision.
Then there's using money for its highest purpose. Use money for time control.
The ultimate goal. Freedom and autonomy are the real dividends.
And, relatedly, be nicer and less flashy.
Because genuine respect comes from kindness and humility, not from showing off possessions.
And the simple, powerful advice, save. Just save.
You don't even need a specific reason. Saving is a hedge against uncertainty. It buys you flexibility, resilience, options. It's rarely a bad decision.
Then understanding the cost, define and pay the price.
Except that market returns require enduring volatility and uncertainty. See it as the fee, not a fine, and be willing to pay it.
And always worship room for error.
Build buffers. Margin of safety is crucial for endurance, and endurance is what lets compounding work. It protects you from the unexpected things that can derail even the best plans.
He also advises avoiding extremes and embracing change.
Because your goals and circumstances will change over time, your future self will want different things. So avoid overly rigid or extreme financial plans. Flexibility reduces future regret. Don't get trapped by sunk costs.
And balance risk-taking with caution. Like risk, paranoid of ruin.
Take calculated risks necessary for growth, but never take a risk that could wipe you out completely.
Know your own strategy. Define your game.
Don't get swayed by what others are doing if they're playing a different game with different goals and timeframes.
And finally,
respect the mess. Accept that finance is complex, context-dependent, and driven by messy human emotions. There's often no single right answer, only what works reasonably well for you. Smart people can disagree.
That's a great summary of practical takeaways. But Housel wraps up with something very personal. His own approach in the Confessions chapter. His core goal isn't being rich, per se, but achieving independence.
That's his North Star. He wants to wake up every day knowing his family has the freedom to do what they want on their own terms. He was inspired by his father, an ER doctor who worked a stressful job for decades, and then one day just decided he'd had enough and quit to pursue other things. That freedom, that ability to walk away, is what Housel values most.
And his lifestyle choices reflect that goal.
Directly. He talks about maintaining a moderate lifestyle that he and his wife established back in their 20s, even as their income grew significantly over the years. This means virtually every dollar of raise has accrued to savings, building their independence fund. They consciously stopped the goalpost of lifestyle desires from moving once they reached a comfortable level.
That takes discipline, and it allows for those reasonable, not rational decisions he talked about.
Exactly, like paying off their mortgage.
Hmm.
He admits that with low interest rates, investing the extra money in stocks would likely have produced a better financial return. It was the rational move on paper.
But they paid off the house anyway.
They did, because the feeling of security, the independent feeling of owning their home outright, provided more value to them than the potential extra investment gains. He says, at some point, you have to choose between being happy or being right.
That's a powerful choice. And he keeps a lot of cash too, right? More than advisors would recommend.
Yeah, he mentions keeping roughly 20% of their assets outside the house in cash. He knows it looks indefensible from a pure optimization standpoint.
So why do it?
He calls cash the oxygen of independence. It guarantees they'll never be forced to sell stocks at a bad time if an unexpected expense pops up or the market tanks. It buys resilience and ensures they can stay invested for the long term. It's a massive room for error buffer that prioritizes peace of mind.
And his actual investment strategy follows this theme of simplicity and reasonableness.
Very much so. He says he moved away from trying to pick individual stocks, finding it incredibly hard to do well consistently. Now he simply dollar-cost averages into low-cost index funds.
U.S. and international.
Yep. Broad diversification, low cost. His reasoning is straightforward. Given their high savings rate and frugal lifestyle, they have a very high probability of meeting their financial goals just by capturing market returns through index funds. They don't need to take the extra risk and effort of trying to outperform the market. He says, I can afford to not be the greatest investor in the world, but I can't afford to be a bad one. Indexing minimizes the chance of being a bad investor.
So it boils down to save a lot, keep lifestyle modest, invest simply and patiently in index funds, hold cash for resilience, and prioritize independence and sleep at night comfort.
That sums up his personal reasonable approach pretty well. It's all geared towards achieving that ultimate goal of controlling his time and living life on his own terms.
What an incredible journey through the psychology of money. It's really driven home how much our financial lives are shaped not just by numbers, but by, well, us. Our psychology, our unique histories, our biases.
Absolutely. From the stark contrast between the reckless tech genius and the frugal janitor, Ronald Read.
To the mind-bending power of compounding over long stretches of time.
The dangers of always wanting more and the seductive nature of pessimism.
It really highlights that our relationship with money is profoundly, deeply human.
And that's the real power of this deep dive, I think. It's not about handing out hot stock tips or a rigid set of rules. As we've seen, what's right is so personal.
It's more about understanding the why, isn't it?
Exactly. Understanding the psychological forces at play, the historical context, the common behavioral traps, knowing why we tend to act the way we do with money. That understanding is what empowers you, the listener, to then make choices that genuinely align with your life, your values, your definition of what enough looks like.
So here's a final thought to leave you with as you navigate your own financial path. Consider not just the returns you're chasing, but also those silent, often invisible prices Housel talks about. Are you paying the necessary fee of volatility and uncertainty to reach your goals? Or are you trying to avoid it, perhaps paying a higher price elsewhere? Are you consciously defining your enough or letting the goalposts drift? Those are the questions that really shape your financial destiny.
Well said. And if this discussion resonated, we absolutely encourage you to grab a copy of Morgan Housel's book, The Psychology of Money. It's packed with even more stories and insights. A truly perspective-shifting read.
Definitely. Well, that's all the time we have for this deep dive. Thank you so much for joining us here on Deep Dive English. We hope this exploration has given you some valuable food for thought on your own journey with money. Keep learning, keep questioning, and we'll see you next time.